Hey guys, welcome to another video, and in this video it's going to be packed full of really useful information which is going to give you the edge that you need in the markets, in the crypto markets specifically, to know how much to diversify your portfolio to stop you losing a lot of money, but also to help you gain a lot more money in the bull runs. So this is a very useful video. It's going to teach you a lot of stuff which I'm guessing you do not know. The only reason why I know it is because over the last few weeks I've been doing a course with an institute of real traders, like from Goldman Sachs, that type of thing. This is really super good course. You can see here I have passed. There's me, distinction 97%, but this is just the beginning. So this is just the basic entry level course, which now that I've passed, I can go on and do the proper course and maybe someday get myself a job with a hedge fund. So this is like a proper institution level course. And it's on this course, which I've realized some of the real hard truths about trading cryptocurrency and why I think you are most likely well too diversified in your portfolio, i.e. you're holding too many coins. So if you're one of the people which has signed up with Mutual Ninja and you've been using our trading bot, trading something like this, the regular stability overload, these stats that you see right here, so it's made 8.5% over the last 30 days. And I gotta say, I think that's true because I've been trading this one and my account's certainly up. On average, you're making 69%, average win 41%, average loss 25. You can go down, you can see some of these trades as they've been coming in just recently. So these closed out on the 21st, it's now the 27th. So it's been 6 days since we've actually made any trades on this. So this isn't something which trades all the time. It's just something which maybe you're going to be trading every few weeks. But it works pretty good. So it does these sort of swing trades in the market. It's a very good strategy, one of the best that we've got, sort of long-term strategies for making money in pretty much any market, even a big bear market like this one. But the problem is this: you see, most people are not really sort of nailing down with conviction the coins that they really believe in. They just go ahead and just copy every single coin, and this is a massive mistake. So in the past, I myself am guilty of this. I've said, just follow all 50 if you like, and that way you'll be exposed to all of the coins when they do take a big hit up. The rest of the coins that you got, maybe the other 49 coins, are going down or sideways, so you don't really seem to make any money. You're just sort of treading water because you're following far too many. And this is called diminishing returns. Let's just say that you hold 2 coins, and while one is going up, the other one is going down. So that means that they're going to sort of balance each other out. Now, that is not necessarily going to be the case, particularly with crypto, because if one goes up, they all seem to be going up at the same time, which is a problem for sure. And there is a way around that, and we're going to get to that towards the end of this video. But as you can see right here, so this is actually stocks. So this is long, large, and mid-cap stocks here in the blue, followed by a long short here in the orange. So different types of strategies using just the stock market. And you can see that this down here is the number of positions. So like 1 position up to 25. Up here is the maximum volatility you would have if you were exposed to just one asset. Obviously, in that case, the one which went up 35%, if you were lucky enough to hold that one. But as you hold more and more coins, the chances of it sort of lessening the risk of your portfolio by holding more assets, holding more coins like in cryptocurrency, this only goes up to 25, and you can see what's happening already. Now, if you're holding 50 coins or trying to trade 50 different coins, then the diminishing returns means that you're not really going to make all that money. So even when you do hit the winners that make good returns, you're not going to see that much change in your portfolio because all the rest of the coins are going to be pulling those averages back down, and you're going to end up pretty flat. So the spreadsheet that you just seen isn't something which I made. It's something I got from doing the course I was doing. That's this course with the Institute of Trading Portfolio Management. Now, that course costs thousands, and I'm not suggesting that you should go on that course yourself, because unless you've got about 30 grand to spare, it's not really something that you're going to be ready for. So maybe like trade for a few years, maybe get to sort of like 50 grand in profits at least before going ahead and doing a more advanced course like that one. But I'm going to go through with you now in terms of crypto. That you just saw was stocks. So we're going to go over the crypto market compared to the stock market, so you can see realistically what the situation is. You'll understand once you've watched this why most hedge funds and like investment banks, etc., aren't all aping into crypto like most of the retail investors. You'll be able to see clearly why actually they can make really good gains with less risk, far less risk in stocks, and why maybe you should look at that, but also how to actually take away some of that risk in crypto if you structure your portfolio in a much more sophisticated way. So this right here is the stocks charts. This is all comparing stocks. This yellow one at the bottom here is the user one. So I can actually change the values for this. This is correlation. So this is how well integrated each of the assets is. So this is basically 17%. So it's a decimal, 0.17 means 17%. And most of these professional traders, they're going to be looking for correlation between -30 to +30%. So in and around as close to zero as you can possibly get. We've got 10 stocks, and then I'm going to compare it against 10 crypto assets so you can see the difference. So we're just taking these stocks here from the stock market. Going down, we can see our portfolio standard deviation, our annual expected return would be ±23%. So that's our opportunity and risk. That's the sort of what we would imagine the portfolio to be up or down after a 1 year period. Down here, we can see the stocks, and this is the correlation between the two. So you can see like Apple and Pega correlated 37%. As I said, we really want to get that correlation figure down as much as we can. As we go over here, we can see that we're all in long positions right now, so we're long only, and we're up at 32%. So if I go back here and say that our correlation is 0.32, and our volatility, I think, was 0.23%. Okay, and then we go. So you can see we're starting off, we've got pretty low volatility, and our stocks bring us out at sort of less risk and less return than just some other stocks that you could choose. So pretty low correlation, you know what I mean. Stellar Lumens and Bitcoin Cash thrown in there. Like, I'm not sure how many people actually hold Bitcoin Cash, whatever. Okay, and you can see here, rather than 23% standard deviation for a portfolio, it's 101%, which is why obviously we see a lot of cryptos, they go down 100%, or at least sort of down 97, down 98%. Here, your portfolio could go down potentially 100%. Which is why cryptos are really, really, really risky. And if you've been in crypto a while, you know that a lot of cryptos do actually go down 100%, the majority, to be fair. So this is very accurate. And once you understand the calculation behind how all this works, which is one of the things you need to do to get this sort of qualification, it's pretty intense, I'll be honest. But this is the numbers, and you cannot argue with these numbers. They are what they are. Okay, so let's go down. So we've got 101 here for portfolio, and our correlation between them all here is a whopping 68%. So that means that basically whatever Bitcoin does, everything else seems to do as well. You can see the correlation here between Bitcoin and Ethereum, 75%. So 75% of the time, or the days or the weeks, Ethereum is moving in exactly the same direction as Bitcoin. Same with Litecoin, Monero, Dash, etc. All of these, they're very highly correlated. You know, struggling here, guys. Here we are. So we got our 68% correlation, that's the one, and annual volatility of 101% puts us way above stocks. So massive opportunity, but it's no different when it comes to your portfolio and how good it is to have more coins. Okay, so this is what I'm saying here about having too many coins in your portfolio. Does it really pay to have 50 coins? Obviously not. It's way too many. If you're holding 50 coins, if you're trying to trade with one of those automated trading strategies, you're following like 50 coins, it's too many, guys. It is too many. Cut down to about 10 seems to be okay for both stocks. So I would say maybe sort of 6 to 10, that type of range is going to be enough so that you can really get into the coins that you know, for whatever reason, maybe they've got like something big coming out soon, like Ethereum 2.0, you know, some sort of good fundamental reason why you're expecting the price to go up or down if you go in short. And that's going to give you much bigger chances to make or lose money in the market. Okay, hopefully make it. And now I really want to move on to what you can do to get that risk down with crypto. And, you know, as you can see, 68% correlation is quite high. So we need to get that down to bring your portfolio risk down, because 101% risk is ridiculous, right? You really don't want to be going in with that much risk. You want to make money, and you can do that by just picking the right direction. But if you're all long, that is going to be a problem. So just take a look what we can do here. And all I'm going to do is, rather than go long here on Bitcoin and Ethereum, I'm just going to go short. So I'm going to change this one and this one to a -1. So that means that we're going short. And that will mean that we are not going to make as much money. So we don't have as much exposure to the market anymore. So we're only going to make 71% compared to stocks. 71% is absolutely epic. Okay, so that is really, really good. And down here, the correlation, because we've gone to minus figures on those two, should be 2. So now scrolling down, we can see that the portfolio risk, or the correlation, sorry, is now only 18.77. So if you remember earlier on, I was saying that the professional investors want to manage their portfolio risk so that they're between -30 to +30, as close to 0 as they can get. In fact, right now, rather than actually being short 2, I would actually be short 8, and maybe find a couple of good ones like Ethereum. Maybe if Ethereum 2.0 is due to come out soon, you might want to invest in that and go long on that one, where you're short on 80%. And you'll find another one. Maybe there's one, I think Waves has been going up right now for whatever reason. You need to find a couple of longs, but then predominantly short, because obviously we're in a bear market. And when we're going up, it's the other way around. Okay, so you'd be predominantly long and you find a couple of shorts just to hedge your portfolio, bring down your portfolio risk, and then just constantly manage this over the weeks and months that you're trading. So over here, what we're going to do is we're going to bring this now down to 0.18, and I think the annual volatility was now just 71 instead of 100%. And there we go. You can see now that is now updated. So you've got a whopping great big curve now coming down from 70 as you add more coins to your portfolio, bringing that you down. So about 10 is about right. So I would really try and just pick maybe sort of 8 to 10 coins. I think is pretty good. Or maybe you could say 8 to 12 coins with 10 in the middle. But you definitely want to be maybe taking a short position to sort of offset your risk. Unfortunately, if you happen to be living in the UK, then that is not an option, because the great pencil pushing geniuses over at the FCA had decided to ban the sale of crypto derivatives, resale consumers, which means crypto futures. It means going short. So even sites like eToro, which are fully regulated, you can't go short on Bitcoin or any cryptocurrency. It's just no longer an option here in the UK, because they've decided that they want all of us guys, all of us retail traders at least, because this does only affect retail consumers, we have to go long only. Long only means we're going to take a lot more risk than the professional traders, which are allowed to diversify their portfolio with short positions. So your only way out of that is really just to leave the UK. And just while we're on the note of stupidity, and the UK. I'm not sure if you've seen this. This is the UK Treasury just a few days ago abandons their plans to introduce KYC on unhosted wallets. So basically like your Trezor wallet or a NanoX, etc. They wanted you to do KYC on a Trezor wallet, on a hardware wallet or a software wallet on your computer. What were they thinking? But that's what they wanted to do. And apparently the EU is also looking to try and do this type of thing. Right now it's been abandoned. If it's going to come back, I don't know. But it's just complete madness. The UK, not really your friend if you're in crypto. Definitely try and get out if you can. That's it for me for this video. I hope you've enjoyed. I hope you've got some insight from this. If you have, please do leave a comment down below. Don't forget to like and subscribe, because I'm telling you now that I've done this course right here, you're going to be seeing a ton of excellent new content over the next year.